Wall Street just placed the biggest bet in housing history. Warren Buffett dumped nearly $1 billion into homebuilder stocks, while institutional investors are building entire neighborhoods they never planned to sell. The numbers are staggering. Build-to-rent communities have exploded 270% since 2019. That's according to the National Rental Home Council, with nearly 25,000 new rental homes completed last year alone, representing over $7.5 billion in investment. And here's what should stop you cold. Blackstone just spent $3.5 billion acquiring 38,000 single-family homes from Tricon Residential, while simultaneously committing another $1 billion to build more. They're not buying homes to flip them. They're buying them to rent them forever. Think about what that means for you. Whether you're trying to buy your first home or looking for your next investment, the game has fundamentally changed. In Phoenix right now, institutional investors are building 13,010 build-to-rent units, more than any other city in America. These aren't apartments. These are actual houses with yards, garages, and white picket fences that you'll never be able to buy. Let me ask you something. When was the last time you saw a brand new neighborhood go up where every single home had a for rent sign? Because in Charlotte, Atlanta, Dallas, and Houston, that's becoming the new normal. D.R. Horton, America's largest home builder, has already delivered over 14,000 rental homes through their build-to-rent series, with $3 billion worth of rental inventory sitting on their books right now. But here's what the data reveals that nobody's talking about. Warren Buffett didn't just randomly throw money at home builders. His Berkshire Hathaway made their first major home builder investment in 25 years, initially buying 5.9 million shares of D.R. Horton worth $726 million and positions in Lennar. Then something interesting happened. He sold all the D.R. Horton by December 2023 after the stock jumped 70%, only to buy back in during 2025. Currently, Berkshire holds over 7 million shares of Lennar worth approximately $800 million, plus a smaller $200 million position in D.R. Horton, combined with an $857 million investment in steel giant Nucor, a key supplier to home builders. Berkshire's total housing-related bet tops $1.8 billion. These aren't small bets. These are calculated moves by the Oracle of Omaha, who sees something most investors are missing. The housing market has reached a breaking point. The median home price sits at $443,141 according to Redfin's latest data, while mortgage rates hover at 6.74%. First-time buyers now represent just 24% of all purchases, the lowest level since 1981. The median age of a first-time buyer has climbed to 38 years old, an all-time high. You need to earn $116,000 annually just to afford a typical home. And even then, you'll be spending 35% of your income on housing. Meanwhile, these build-to-rent communities are charging premium rents. The average BTR home rents for $2,205 per month. That's 25.7% higher than traditional apartments at $1,754. In Miami's Biscayne Shores, luxury BTR units go for up to $6,900 monthly. Yet occupancy rates remain rock solid at 95%, with turnover rates of just 30% compared to 45% for traditional apartments. Now, here's reveal number one that changes everything. Lennar partnered with Invitation Homes through their Quarterra subsidiary to manage 4,400 single-family rental homes, with another 700 added just last quarter. This isn't some small pilot program. Invitation Homes, which already manages 110,000 homes nationwide, received a 7.2% stake worth $37.5 million in the joint venture called Upward America. The platform launched with $1.25 billion in equity commitments and leveraged capacity to acquire over $4 billion in homes. But Lennar's executives have made clear they're pivoting toward building rental product for institutional investors rather than homes for individual families. Lennar's executive chairman Stuart Miller revealed the real strategy during their March 2024 earnings call. The new focus on multifamily is to be building in a more distinctly private equity-based program where we become much more of a production engine for more affordable product. Affordable rental product is very desirable and something that we can produce much more comfortably within the Lennar home building division. Translation? They're not building homes for families anymore. They're building them for Wall Street. The scale of institutional investment is unprecedented. Pretium Partners has poured $2.5 billion into build-to-rent construction since 2020, creating a portfolio of 8,000 BTR homes across 37 cities. They just raised another $1.5 billion in July 2024, above their target for their sixth single-family housing fund. Say that 5 times fast. Their total SFR portfolio now encompasses 85,000 homes, making them the second largest single-family rental owner in America. But here's where it gets really interesting. Blackstone doesn't just own homes through Tricon. They also acquired Home Partners of America for $6 billion, adding another 26,516 homes to their empire. Combined, Blackstone controls 61,964 single-family homes, making them the third largest player behind Progress Residential's 83,502 homes and Invitation Homes' 81,716. These three companies alone control over 227,000 American homes, and they're generating serious returns. Blackstone's Bright Fund posted a 9.4% annualized return since 2017, with 96% of 2024 distributions classified as return of capital for tax benefits. The distribution rate sits at 4.8% pre-tax, or 7.5% on a tax-equivalent basis. These aren't speculative investments, they're cash-flowing machines. D.R. Horton's CEO David Auld laid it bare in June 2023. I firmly believe we are still in an extremely undersupplied housing market for both new and existing homes, likely for years to come. The numbers back him up. America faces a housing shortage estimated between 1.5 and 3.8 million units, depending on who's counting. With 82% of homeowners locked into mortgages below 6%, existing inventory isn't coming to market anytime soon. Please take 2 seconds to help me out and hit the like and subscribe if you find this video interesting so far. Each like, subscribe, and share helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, let's continue. Here's reveal number 2 that should concern every potential home buyer. The build-to-rent boom is accelerating, not slowing down. In Houston alone, BTR completions surged 187% year over year. Huntsville, Alabama saw a mind-blowing 255% increase. Currently, there are 110,000 BTR units in the development pipeline nationally, with Phoenix leading at 13,010 units, followed by Dallas at 8,450 and Atlanta at 6,644. These aren't random locations. Texas added 563,000 new residents between 2023 and 24. Florida gained about 1.8 million residents between 2020 and 2024, and 467,347 new residents between 2023 and 24. Phoenix Metro added 85,000. Institutional investors are following population growth with surgical precision, ensuring their rental empires sit exactly where demand is highest. What's particularly telling is the shift in builder behavior. D.R. Horton recently pivoted to selling BTR communities before they reach full occupancy to improve capital efficiency. They're not even waiting for stabilization anymore. They're flipping entire neighborhoods to institutional buyers as fast as they can build them. The partnership between D.R. Horton and Pretium Partners exemplifies this new model. In 2023, Pretium bought over 4,000 D.R. Horton homes for $1.5 billion, a mix of completed homes and properties under construction across Southeast and Southwest markets. The average price? About $375,000 per home. These homes immediately entered Pretium's Progress Residential platform for permanent rental. But here's what really should make you pause. Currently, 37% of builders are cutting prices by an average of 5%, the highest percentage since tracking began in 2022. Another 62% are offering sales incentives. New home inventory has reached 481,000 units, the highest since 2007, with speculative homes at 385,000. Levels not seen since 2008. Yet institutional investors keep buying. They're not worried about a crash because they're playing a different game entirely. The rental math is compelling for these institutions. With traditional apartment vacancy rates hitting 7.1%, an all-time high, BTR communities maintain steady 95% occupancy. Tenants stay an average of 4 years in BTR homes versus just 15 months in apartments. The stability alone justifies the premium pricing. Now, here's reveal number 3 about market dynamics. In markets like San Jose, you need an annual household income of $237,000 to afford a mid-tier home. That's 2.5 times the median income. In California overall, 88% of income goes toward housing costs in some areas. These aren't sustainable numbers for individual buyers, but for institutional investors collecting $2,500 monthly rent, it's a gold mine. The data suggests we might be approaching a market inflection point. Home price growth is decelerating from 4.7% in May 2024 to just 1.1% year over year, according to Redfin's latest numbers. Zillow has progressively revised their 2025 forecast downward from 2.9% to 0.8%, with some models showing a potential 1.7% decline. Sales volume sits 25% below 2019 pre-pandemic levels. Yet build-to-rent development charges forward. The National Association of Homebuilders reports that 7.9% of all single-family housing starts in 2023 were build-to-rent, triple the historical average of 2.7%. Through Q2 2024, we've seen 83,000 BTR starts, a 20% increase over the prior 4-quarter period. But wait, there's more complexity here. The lock-in effect created by low mortgage rates is slowly eroding. The percentage of homeowners with sub-6% mortgages has dropped from 93% to 82%. Freddie Mac projects rates might ease to 6.3% by late 2025, down from today's 6.74%. This could theoretically increase existing home inventory, but here's the catch. New construction still offers better deals through builder incentives and rate buydowns. D.R. Horton openly advertises interest rate buydowns, often offering a full percentage point below market rates for the life of the loan. As their CEO noted, our most successful incentive recently has been interest rate buydowns. When builders can offer 5.7% rates while the market sits at 6.7%, traditional sellers can't compete. The investment thesis for Wall Street is crystal clear, with 53% of experts believing tariffs will drive increased BTR demand and millennials representing 64% of BTR renters. The demographic tailwinds are powerful. Gen Z adds another 49% to demand. These generations sadly face the worst homeownership affordability crisis in history, making them captive rental customers for potentially decades. Here's the final reveal that ties everything together. The build-to-rent explosion represents the largest transformation of American housing since the suburban boom of the 50s. But instead of creating millions of new homeowners, we're creating a permanent renter class. When Warren Buffett, Blackstone, and every major home builder pivot toward rental production, they're not betting against home ownership temporarily. They're betting it's permanently broken for most Americans. The evidence is overwhelming. First-time buyer participation at 24% versus the 38% historical average. Median buyer age rising to 38. Down payments climbing to 9%, the highest since 1997. Housing payments consuming 35% of median income versus the recommended 30%. These aren't cyclical trends that will reverse with lower rates. These are structural changes to the American dream. Phoenix's 13,010 unit BTR pipeline isn't an anomaly. It's the future. Dallas's 8,450 units, Atlanta's 6,644 units, Charlotte's 4,886 units. These represent entire neighborhoods where ownership isn't even an option. When completed, these communities will extract $25 to $30 million in annual rent that previously would have built family wealth through equity. So what does this mean for you right now? If you're trying to buy, you're not just competing against other families anymore. You're competing against companies with billions in capital who can pay cash, waive inspections, and close in days. If you're an investor, you need to understand that the smartest money in the world has decided that owning American homes as rentals is the trade of the decade. The question isn't whether build-to-rent will reshape American housing. That's already happening. The question is whether you'll adapt to this new reality or get left behind. Because when Wall Street billionaires are building entire cities they'll never sell, the old rules of real estate no longer apply. The game has changed, and if you're still playing by yesterday's rules, you've already lost. If you found this video interesting, please subscribe, share, and watch this one as well.